Here is a risk almost nobody in finance is talking about. Not the risk that Bitcoin crashes, not the risk that governments ban it or regulate it into the ground. The risk that Bitcoin simply becomes unavailable. That by the time the majority of people decide they want meaningful exposure, there is not enough left to buy at any price they are willing to pay. That is not a theory. That is an arithmetic problem. And the numbers are already in motion. If you are watching this, you already hold some Bitcoin. You already made that decision. But there is a difference between holding Bitcoin and understanding what you are actually holding. And that difference is what this video is about. Because if the supply picture is even half as tight as the on-chain data currently suggests, the conviction required to hold through a 47% drawdown is not stubbornness. It is one of the most rational positions in the market right now. Let's start with what everyone thinks they know. 21 million. That is the total number of Bitcoin that will ever exist. Hard-coded into the protocol, immutable. No central bank can print more. No government can authorize more. No institution can vote to change it. That part most people understand. What most people do not fully process is that 21 million is not the supply. It is the ceiling. The actual number you need to think about is much smaller, and it is getting smaller every month. As of April 2026, approximately 19.8 million Bitcoin have been mined. But from that number, you immediately have to subtract what the market will never see again. Blockchain analysis consistently estimates that between 3 and 4 million Bitcoin are permanently lost. Early wallets abandoned when coins were worthless. Private keys written on paper that no longer exists. Coins sent to addresses that will never be accessed. The original holdings attributed to Satoshi Nakamoto, roughly 1 million Bitcoin, have never moved in the entire history of the network. That is not a sign of a holder waiting for the right price. That is effectively retired supply. So before you account for a single current holder, the functional ceiling drops from 21 million to somewhere between 15 and 16 million. That is the real number you are working with. Now go deeper. Long-term holders, defined as wallets that have not moved their coins in over 155 days, controlled more than 70% of all circulating Bitcoin through multiple on-chain reports in 2025. These are not traders watching charts. These are entities, both individual and institutional, that have demonstrated across multiple cycles that they do not sell during volatility. They accumulate, they hold. And historically, once their coins age past a certain threshold, they almost never return to exchanges. So your liquid supply, the Bitcoin that is actually available for someone to buy right now at market price, is a fraction of the fraction. And it is shrinking. Then in April 2024, Bitcoin went through its fourth halving. Every 4 years, the protocol automatically cuts the reward miners receive for processing transactions in half. Before April 2024, approximately 900 new Bitcoin entered the market every day. After the halving, that dropped to 450 Bitcoin per day. At the current price of around $66,000 per coin, that is roughly $29.7 million worth of new supply entering the market daily. Now compare that to the inflow numbers from the US spot Bitcoin ETFs during active periods in 2025, which frequently exceeded $500 million per day. That is not a small imbalance. That is demand outpacing new supply by more than 10 to 1. That gap has to be filled by existing holders. And existing holders, as the on-chain data keeps showing, are not selling. Before we go further, drop a comment right now and tell me where you are watching from. I want to know what part of the world is paying attention to this because the macro pressure on this trade looks very different depending on your local currency situation. Now let's talk about where the coins are actually going because this is the part that changes how you think about price entirely. In August 2020, Strategy, then called MicroStrategy, made a decision that looked eccentric at the time. It converted its corporate treasury reserves into Bitcoin. Most analysts called it a gimmick. Some called it reckless. By early 2026, Strategy held over 720,000 Bitcoin. That is approximately 3.4% of the total supply that will ever exist, sitting in cold storage under a single company's balance sheet, not being traded, not being lent, not re-entering circulation. Michael Saylor has described this as a one-way door. Coins go in, they do not come back out. Whether you find that inspiring or alarming probably says something about your own positioning, but the supply implication is the same either way. Then came the ETFs. BlackRock's iShares, Bitcoin Trust, known as IBIT, accumulated roughly 485,000 Bitcoin by early 2026. Total U.S. spot Bitcoin ETF holdings exceeded $128 billion. And the important thing to understand about ETF flows is that they do not behave like exchange trading. When capital enters an ETF, Bitcoin is purchased and moved into custodial structures built for long-term holding. It is not speculative capital rotating in and out. It is institutional capital that came in with a multi-year time horizon and is not looking for an exit next quarter. So now take a step back and look at what the supply picture actually is. You have 3 to 4 million coins that are permanently gone. You have Satoshi's million that have never moved. You have the long-term holder majority that controls over 70% of circulating supply and does not sell during drawdowns. You have Strategy's 720,000 coins in cold storage. You have the ETFs absorbing hundreds of thousands more. And sitting underneath all of that, you have a halving that just cut new daily issuance in half. What remains liquid is not a 21 million coin market. It is a thin, fragmented layer of available supply being approached from multiple directions by buyers with entirely different time horizons and entirely different mandates. And when a scarce asset is approached that way, price does not gradually drift higher. It moves in compressions and then sudden, violent repricing events, because the marginal seller, the last person willing to part with coins at a given price, has to be found at ever higher levels. That is not speculation about what Bitcoin might do. That is how supply-constrained assets have behaved in every market where this dynamic has played out. Manhattan real estate in the 1980s, prime agricultural land in the U.S. Midwest over the past 2 decades, category-defining art. In every case, the early participants who understood the supply dynamic looked foolish during drawdowns and prescient over the full cycle. The pattern is not new. The asset is. And right now, in April 2026, with Bitcoin sitting 47% below its October 2025 high, retail interest cooled, search volume down, media coverage quiet, the question is not whether you made a mistake buying it. The question is whether you understand what is happening quietly while the crowd is looking somewhere else. Because what is happening quietly is accumulation. And accumulation, by definition, is only visible in hindsight. Part 2. There is a principle in financial markets that most people understand abstractly, but almost nobody internalizes until they have been burned by ignoring it. Price is not set by total supply. Price is set by the supply available at the moment someone wants to buy. That distinction sounds minor. It is everything. Think about what that means for Bitcoin right now. If the liquid supply, the coins actually sitting on exchanges, available for immediate purchase, represents somewhere between 5 and 10% of total circulating supply, then the price you see on your screen is being set by an extraordinarily thin slice of the market. A small shift in demand does not gently push that price higher. It slams into a wall of illiquidity and the price gaps. We have already seen this mechanism in action twice in the last 5 years, and both times it caught the majority of market participants unprepared. Between October 2020 and April 2021, Bitcoin moved from $10,000 to over $60,000 in 6 months. That was not retail mania driving it. Retail followed after the move was already well underway. What drove the initial surge was institutional inflows colliding with a supply that had already been quietly tightened by long-term holders in the 2020 halving. The demand was not enormous by the standards of traditional markets. The available supply was just that thin. The same dynamic ran again from mid-2024 into late 2025 when Bitcoin moved from the $30,000 range to over $126,000. The spot ETFs had just launched. Institutional infrastructure was operational for the first time. Fresh demand entered a market where supply had been contracting for years. The result was not a gradual climb. It was a compression followed by a vertical move that most analysts did not forecast because they were modeling demand without properly accounting for available supply. Now consider what the setup looks like today. Bitcoin is at $66,000, which means it is sitting 47% below its all-time high. Post-halving issuance is at the lowest level in the asset's history. Long-term holders are not showing selling behavior. Exchange balances, meaning the coins most immediately available for purchase, have been trending downward for years as more Bitcoin moves into self-custody and institutional cold storage. Strategy is actively acquiring and has outlined plans to raise up to $84 billion for continued Bitcoin purchases over time. The ETF infrastructure is fully operational and has already demonstrated it can absorb billions of dollars in daily inflows. And the broader macro environment, with global debt expanding and central banks continuing to debase their currencies, has not resolved in a way that removes the original monetary argument for Bitcoin. And now layer in what has not happened yet, but is moving toward happening. The United States government has openly discussed the concept of a strategic Bitcoin reserve. If even a small number of sovereign governments begin allocating reserve assets into Bitcoin, the demand profile stops being institutional and becomes geopolitical. At that point, Bitcoin is no longer competing for capital with stocks or speculative assets. It is competing with gold as a sovereign reserve instrument. The global gold market is estimated at approximately $17 trillion. Bitcoin's total market cap in early 2026 sat around $1.3 trillion. A partial substitution of even a few percentage points of gold allocation into Bitcoin would represent demand that exceeds the entire current liquid supply of the asset multiple times over. This is what a supply shock actually means. not simply strong demand. Demand overwhelming available supply at every prevailing price level, forcing price higher and higher until enough sellers emerge to satisfy buyers. In a normal market with elastic supply, this resolves quickly. Producers make more. Supply expands. Price stabilizes. Bitcoin cannot do that. The protocol will not allow it. Which means the only resolution mechanism is price. And if the sellers at each level are structurally declining in number, the price required to find them moves in ways that linear models do not capture. Now let's be honest about the counterargument, because if you hold Bitcoin, you have heard it, and you need to be able to answer it clearly in your own mind. Bitcoin has fallen 78% before, from $69,000 in November 2021 to $15,000 in November 2022. It has fallen 47% from its most recent all-time high right now. These are not small corrections. They are severe, sustained, psychologically brutal drawdowns that have ended the conviction of millions of holders who sold near the bottom of each cycle and watched the recovery happen without them. That is a real risk, and it deserves honest acknowledgement. But here is what the drawdowns have consistently failed to do in the entire 15-year history of this asset. They have failed to return coins to the market permanently. What on-chain data shows after every major correction is not distribution, it is transfer. Coins move from holders with short-time horizons, people who panic sold, to holders with long-time horizons, people who bought the panic. And once that transfer happens, those coins age. They stop moving. They join the long-term holder cohort. And that cohort grows with every cycle. The volatility is not a contradiction of the scarcity thesis. It is the mechanism through which the scarcity thesis plays out. Each cycle shakes out the holders who cannot psychologically tolerate the drawdown, transfers their coins to holders who can, and leaves the liquid supply slightly thinner than it was before. Repeat that process across 4 cycles with increasing institutional participation, and what you get is exactly what the on-chain data is showing right now. A market that is quieter than it should be at this price level, with coins moving off exchanges, with long-term holder balances at or near record levels, and with new demand infrastructure fully built and waiting for the next trigger. The risk that most people are not pricing is not losing money on Bitcoin. Most people holding Bitcoin have already lived through losing money on Bitcoin. The risk they are not pricing is the risk of not having enough, of watching the next repricing event from a position that is smaller than it should be because they reduced their holdings during the drawdown, or never added during the accumulation window that, by definition, closes before most people realize it was open. There is a version of this story where Bitcoin at $66,000 in April 2026 is remembered the way Bitcoin at $10,000 in October 2020 is remembered now. Not as a price that looked obviously cheap at the time, because it did not. The fear was just as real. The drawdowns had been just as severe. The skepticism was just as loud. But as a price that, in hindsight, reflected a fundamental misunderstanding of how much supply was left and how much demand was coming. The data does not tell you exactly when the next demand wave arrives. Nobody has that answer. What it does tell you is the shape of the market you will be operating in when it does, less liquid than it appears. More concentrated than it has ever been, with new institutional buyers who did not exist in previous cycles and sovereign-level interest that has never been present before. And with a daily issuance rate that is lower than at any point in the asset's history, falling further with each successive halving on a fixed and immutable schedule. By the time the next move is obvious to everyone watching, the price will already reflect it, the coins will already have moved, the window will already be smaller than it is today. That is not a prediction. That is just how supply-constrained assets with growing demand have worked in every market where this dynamic is played out. Bitcoin has all of the structural properties required for the same outcome. Fixed supply, transparent issuance, global accessibility, and now, for the first time, the institutional infrastructure to absorb serious capital from serious players. The only question that actually matters at this point is not whether you believe in Bitcoin. You already do. You already made that decision. The question is whether your position reflects what you actually believe about the supply picture, or whether you are holding an amount that was sized for a different version of this story. One where supply was more abundant, demand was less institutional, and the window to accumulate at these prices was longer than the data suggests it actually is. The pattern is already in motion, the supply is already contracting, the demand infrastructure is already built. The only variable left is timing, and timing in a supply-constrained market is the one thing you cannot wait to get perfect.